Robschild. No investment advice. Welcome to the show where we view financial markets through technical analysis, macro financial history, Benjamin Graham's investment philosophy, and of course, crystal ball gazing. Today is Friday, September 20th, 2024. Today's episode, we're going to start talking about junk credit spreads. I wanted to bring up this chart again today. I've talked about it recently. I've been talking generally about credit spreads being surprisingly tight lately, especially considering where we are in the cycle. Just today, if you look towards all the way to the right of this screen, well, I guess it was yesterday, we got down to 3.1. Over the past several trading days, it looks like credit spreads were widening a little bit, but now we're going straight back down. It doesn't often get as low as around 3%. Again, this is the spread between treasury bonds and basically all bonds that have a grade that's lower than investment grade bonds, so BB and below. You can find this chart on the Fred. If we scroll out throughout history, the current view of this chart going back to 2007, you can see it's not very often we get down to 3. Even all the way from the great financial crisis up through, basically COVID, I don't know if we ever got down as low as only a 3% difference between junk bonds and treasury bond yields. A few times when junk bond spreads were unusually thin happened to be right at the end of the 90s, right before the dot-com bust, but of course we had credit yields spreading going into that. That was kind of a clue that bad things were coming as investors realized that the junk bonds were not as safe as they had previously thought. And the other very notable time that it got actually below a 3% differential of year credit spread yield was right before the great financial crisis. It was in May of 2007, where it was only 2.46. Notably, there are periods that can last a long time where this spread is around between 4 and 5% difference. Taking a look right before the beginning of the financial crisis, 2007, we were like averaging around that all the way up until COVID, it looks like. We only dipped down towards the 3s a few times, really. I talk about often in these shows how unbelievably tight credit spreads are between junk bonds and treasury bonds, and this is why. This is what I'm talking about. This is why I have puts on HYG. It's because I believe that we're in a place where spreads can easily get wider and not very easily get very much tighter here. So I think this is a huge investment opportunity for going bearish on junk bonds. Of course, like I said yesterday, I'm not playing this with all of my money, my entire portfolio. I'm talking about using 0.5% to maintain put options contracts, which can blow up to become 20% of your whole portfolio. If you end up doing it right, timing it right. But the risk reward here is very nice. I like it. As I've said in previous shows, even Benjamin Graham says explicitly, never pay full price for junk bonds. They're not worth full price. And when credit spreads are really, really thin, it basically says people are paying full price for these things. Junk bonds are amazing. They're great to have when they're on discount, and they often become on severe discounts. In the dot-com bubble burst, the discount was huge. The spread was 10% between these junk bonds and treasury yields. In the financial crisis, we peaked at 20%. difference between the yield. That's huge. We had a spike in 2011 all the way up to 8.5%. We had a spike in 2016 to 7.8%. These spikes happen all the time, whether they're small or large. I'm expecting a large one coming. And also the COVID dip. I'm not sure this shows the full gravity of the dip because of how fast it was, but the difference, the bottom of the COVID dip being 8.8%. Graham talks about insecurity analysis. These things frequently become severely discounted, and if you get a diversified amount of them, some of them will go bankrupt, but overall, when the tide comes back in and they become more reasonably priced, you can make a very easy fortune. And again, the way that I plan to do this is to simply get HYT. It has more beta than HYG. I think the overall credit rating is lower, and so it has higher beta. So yeah, they're not on discount right now, and so I'm on the opposite side. I'm basically shorting it. Other main thing of today, notably next Thursday, we have the second revision of quarter 2 GDP. Now, the original GDP that came out, the initial was 2.8%, and oftentimes when we're headed into a recession, these get revised downward, and the first revision of this actually revised it up to 3%. So this second revision could be huge here, especially if we go back down to 2.8% or even below 2.8% on this second revision. For where we are in the cycle, it would actually make sense to me, again, for this actually to be revised back down. Sorry, but not sorry for the daily reminders. 2-year, 10-year Treasury yield curve was inverted for over 2 years. Reversion happening on September 6th. This never happens. It pretty much only happens before the Great Depression, suggesting that's where we're headed. Somme rule triggered. Unemployment is skyrocketing. Even though it's still low, it's going up really fast. This only happens when a recession has already started. The S&P 500 is now actually at a PE of 30, previously 29, without even seeing major earnings contraction. And bond yields are not super low, so this PE ratio doesn't make any sense. This is an extremely expensive market. The rate cutting cycle began on the 18th, 2 days ago, with a 50 basis point cut, suggesting that the Fed is scared of the slowdown here. I don't even need a crystal ball to predict with pretty strong surety that a market crash is coming. The bears are coming. They're on the other side of the wall. Winter is coming, friends. And I also believe that the Fed will not cut fast enough to save the economy. We have a lot of debt in the United States. A lot of people think that we're close to fiscal dominance, or at least more fiscally dominant than we've been maybe ever before. This makes hiking less effective, and it also means cutting is less effective. Inflation has been cooling off faster than anybody expected already, and I expect this to continue. And this is what happens when you're headed into disinflation, deflation, market crashes, etc. On to some charts. The S&P 500. This is SPX on a daily time frame. I had previously talked about this being a head and shoulders top, then we started looking like it might be a double or a triple top, and that's broken now. We are now above the previous top, and so if we are to try to figure out a new pattern, we would take these two lows and make a parallel channel here. So if we continue upward, there might be some resistance here at this line, so 57.63 around there. today's action was neither very bearish or bullish, just going sideways. Again, today was an options expiry date, so the institutions pretty much like hold the market where they make sure that like as many, the most amount of contracts they've been selling in the options markets go worthless. So everybody buying these options contracts lose, everything that that they paid for these. They lose all the premium. So yeah, very exciting times in markets. I do expect we're very close to all-time highs if we're not already past the all-time high. The triple Qs, the NASDAQ, we still have this formation of a head and shoulders top. And so if this does play out, it can drag the S&P 500 down with it, as it would make sense. Again, with everything that I mentioned at the beginning of this video, all my daily reminders, this market is just insanely expensive. There is no intelligent investing going on at these levels. And although markets are not a weighing machine, they're a voting machine, eventually the weight does matter. VIX futures curve doesn't look as crazy as it had been, but the October contract is still elevated past the next two contracts. This is with the VIX not being even with the VIX being fairly low right now, the October is still elevated here. So we're still expected to have a lot of volatility coming up in this market. This is like professionals are in this market. They see major volatility coming up, in my strong estimation. TLT, my favorite place to be for considering the valuations of markets and where yields are right now. I still expect yields to drop here. We haven't really seen the run to safety even begin yet. We saw a little taste of it with, in August 5th, it was the yen carry trade blow up. That was just a little taste of it. The U.S. equity markets are not scared at all. Credit spreads are incredibly tight. It won't take much for money to flood into things like TLT, in my strong opinion. Although we went sideways down a little bit today, this little trend line is still in play here, I'd say. So it still looks like it could be a buyable dip here. I don't really know if it'll go sideways, down a little bit, up a little bit. I don't really care. I just think it's a good investment at this time, personally. Again, none of this is ever advice, and I'm literally the guy with the crystal ball here. Sorry, I should have put this earlier in the video. This is a weekly time frame of the S&P 500 as well. Another way of looking at this chart is us being in basically a parallel channel. And so on a weekly time frame, it appears that we could be maybe bouncing off of this high part of this channel for the moment. One interesting thing that caught my eye today is the Fed funds futures. The November expectation, November meeting for the Fed funds changed pretty strongly today. Much higher chance of another double cut, another 50 basis point cut. So yesterday, double cut was at 34%, and today it rose to 45.5%, suggesting, we're 50-50 here. And if we keep going in this direction, and I don't really know what is driving this to have markets predict another 50 basis point cut today, but I do find it very interesting. Again, as I've been saying in the show many times, the hiking cycle, we kept pushing out, when after the hiking cycle, when we were looking for the first cut, we were thinking like, oh, it's like 7 or 8 months away, and then the next month, oh, it's still 8 months away. We kept doing this. We kept pushing it out, and that's what happens when you have a lot of debt. The monetary policy is not as effective. Now, again, we're on the other side of the coin. We get the cuts. The market is realizing maybe, the cuts are not going to be strong enough. They're not going to be as effective. as we thought before. And already today we're seeing, another double cut. Just remember, it was only a week ago where the market was pricing in a higher probability of 125 basis point cut for the first meeting. We flipped to a 50, and now we're looking at this one. That one was the 50 basis point cut, and now the next one looks like there's an increasingly larger chance of there being a 50 basis point cut here. So very exciting markets right now. Last few items here. Silver getting a bid. I had drawn this previous trend line here, and I said, if we closed above it, maybe it couldn't get bullish here. I know that part of this narrative is that it looks like China might be at the end of this little recession or depression or whatever they've been experiencing. They've already cut, by the way. They've been in easy monetary policy mode for a while, trying to get things going again. And if their economy does turn on the engine, silver is another one of those markets where it can do well because China uses silver. They use copper, they use oil. And so that might be part of this silver breakout here. Last chart, I like to use wood as a decent leading indicator as to where markets are, where they may be going. I've been noting how strong this market has been going, and we really gapped up yesterday, and this is a blow-off top. This is blow-off top movement moving back down. So I don't know where this is headed, but it caught my eye. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching. See you next time. Robschild.